The history of the primary credit rate 2003 to 2008. Before we get started on that, just a quick review on the history of the federal funds target rate and the discount rate from 1982 to 2003. Notice that the federal funds rate tended to lie above the discount rate for many of these years during the 80s, during the 90s, where sometimes the discount rate and the federal funds target rate were the same, but most times the federal funds target rate lied above the discount rate until January of 2003. Now remember, back at this period of time, if a bank tried to borrow at the discount rate because the discount rate was lower than the federal funds rate, the Fed wouldn't look kindly upon this. The Fed used what was called moral suasion as an unwritten tool of monetary policy. Historically, there was the stigma associated with borrowing from the Fed at the discount window as compared to at the federal funds target rate, which was seen as a sign of weakness by the banks, which could lead to banks being reluctant to borrow from the Fed. Also back then, the use of the discount rate could trigger heightened attention from bank regulators, and one of the last things a commercial bank wants is bank regulators looking over their books. So anyway, in January of 2003, the discount rate was discontinued. And instead of the discount rate, the Fed used a newer rate called the primary credit rate, which we'll get into in just a moment. The Federal Reserve put out a press release on January 6, 2003, stating that the primary credit rate would take the place of the discount rate, and the primary credit rate would be set at 2.25%. And the primary credit rate was set 100 basis points above the federal funds target rate. So the Open Market Committee, current target of 1.25% for the federal funds rate. So they set the primary credit rate 100 basis points above the federal funds rate. So now we're going to take out our economic microscope and blow up this area on a Fred graph for you to understand what happened. Notice by 2002, the discount rate still was below the federal funds rate by 50 basis points. Then, in that same year, as you can see, the federal funds rate went down to 1.25, and the discount rate went down to 0.75. Then, on January 9th, 2003, a major occurrence happened with monetary policy. The Fed discontinued the discount rate and changed it to the primary credit rate. And to this date, people still call this rate, this new primary credit rate in 2003, they still call it the discount rate. The reason being is the Fed had called it the discount rate for many years afterwards because they didn't want to change the name to confuse people. And it stuck over all of these years for over a quarter of a century. But let me show you why. If you look up at the top, this primary credit rate is through the discount window where the discount rate used to be set. Do you remember if banks went to the Federal Reserve and tried to borrow at the discount rate, bank regulators would be all over them. But once the primary credit rate set, banks could go and get that primary credit rate, which was set 100 basis points above the rate where banks lend to each other at the federal funds target rate. Banks can go to the Fed and borrow at an extra 100 basis points or 1% higher with no questions asked. And so really this rate was set as a ceiling interest rate. And really, this was the start of the primary credit rate being the ceiling rate for the federal funds target rate. So the primary credit rate was an excellent way to make sure that this was a ceiling rate, because if the banks couldn't borrow from the Federal Reserve in case of some sort of financial crisis, then where are they going to get the funds? But this continued on, and you'll see in the next slide how this new primary credit rate was a really good administrative tool of the Federal Reserve. Notice the spread between the primary credit rate and the federal funds target rate remained 100 basis points for a very long time, even as the federal funds rate and the primary credit rate were rising. The spread still remained 100 basis points all the way up until the summer of 2006. So let me show you what that looked like on the limited reserves graph to the left. The federal funds rate went up to 5.25, and the primary credit rate went up to 6.25. By August of 2007, the spread narrowed to 50 basis points. And this spread of 50 basis points went on until March 14th. The primary credit rate was at 3.5 and the federal funds rate was at 3, which meant that there was a 50-point basis spread between these two rates. Then on March 18th, notice that the spread changed to 25 basis points. The federal funds rate dropped to 2.25. Let's show that on this limited reserve graph. And the primary credit rate dropped to 2.5. And the primary credit rate drops to 2.5%. which becomes a spread of only 25 basis points. Now realize you can see in the gray area on the Fed graph, we are getting deeper into this Great Recession of 2008. And the Fed is lowering the federal funds rate as fast as they can, and then squeezing the spread between the primary credit rate and the federal funds target rate to just 25 basis points. Let's see what happens over the next 5 months. Until October 14th, 2008, when the federal funds target rate drops to 1.5% and the primary credit rate drops to 1.75%. So let's show that on the limited reserves graph. The federal funds rate drops to 1.5% and the primary credit rate drops to 1.75%. A 25 basis point spread. This is now the end of the limited reserves framework. At this point, the Fed does something drastic and decides to shift from a limited reserves framework where the reserves are scarce or the reserves are limited to what's called the ample reserves framework, which was a brand new framework that the Federal Reserve initiated at the end of 2008. So to learn more about this transition, please look at the lesson on the history of ample reserves. I hope this helps you in understanding the limited reserves of the Federal Reserve from 2003 to 2008.